All right. Well, this is the beginning of this series of video, and the whole idea is that to show how consistency with a goal to learn this particular in this case is how to improve my financial literacy can give me some outcomes. So consistency plus a goal to get some outcomes. And well, this is something that I'm dedicating is from 29 6 2012. Well, this is a Spanish date, not a US date. So I begin this in June 21, 2022, right? And how to secure yourself financially. Secure yourself. So, well, I ask myself that question. So I look at the Investopedia, which is a financial media web service headquartered in New York and founded in 1999. In 1999, so this were the place where I start to look at how to improve my financial literacy. So on this link, we have is the best free and in-depth experience. So I choose is the best free and in-depth experience. Free because of course, hey, I'm a Latin American, and with this. So investing classroom from Morningstar. So I started to look at the feature content. So here we have on the investing classroom 7 sections. The feature content, stocks, funds, portfolio, bonds, ETF, and this is something new. I mean, 7 section, sorry. Uh, but this is something new, the environment, social, and governance. So I begin here with the feature content, okay? And again, inside of this course, we have is 7 section talking about that. So staying investing in the market and terms and recovery, asset class and downturns, risk and volatility data, investment strategy for a volatile market. So don't focus too much on the short term and dealing with financial stress. So almost 6 months ago, I started to look at the staying investment in the market. Okay, so they show me is how performance data makes a case for staying put rather than selling my investment. And the importance of staying investment is by looking at the historical graph or an examination or a 94 years examination of the past capital market returns of different asset class such as government bonds, treasury bills, small and large stocks, and inflation in an hypothetical $1 bet on the market in January 1st, you got here, January 1st, 1926 through December 31, 2019, right? Uh, and so the things to know of this is that small and large stock has provided the highest return and increase in the wealth. So when you compare with this, uh, so yeah, small and large stock has provided this huge or this huge return compare with something called fixed income investment. This right, such as bond, certificate of deposit, uh, treasury bills, where they only provide is a fraction of that. So government bonds and treasury bill they are only guaranteed by the full faith of credit of the United States as they timely payment of principal and interest. And this is something interesting because there are several concepts involved here, such as capital, market, returns, and principal and interest. something perhaps the interest I know what it is. But for example, is capital according to Morningstar? Capital is a wealth or is a form of wealth, or is a wealth in the form of cash or property that can be used to earn income. In the context of business, is the amount of asset in which, or is that relationship in which your assets are greater than your liabilities, or is something that you own free and clear. So, for example, your time. So, the market is a place where buyers and sellers make transactions, uh, and the return is the earning on security or other investment. So whether there are dividends or interest, realization of profits, income, and some other source. So, and it is also funny to mention, to see here, for example, concepts like growth and inflation, okay, uh, especially on the growth, which is the gain in value. So in business, growth is the measure by the expansion of asset and sales. And this is something important. So growth, according to Morningstar, is the expansion of asset and sales. But in the reality, growth measure is productivity. Growth is only measure the expansion of assets and sales. But what about productivity? So in security, it refers to increasing the market price. And then you have inflation. Uh, yeah, it's a rise in the price of, it's a rise in the general price level of goods and service. Inflation is the opposite of deflation. This is something important here. The consumer price index and the producer price index are the most common measure of inflation. So when you started to see on news the consumer price index and the producer price index, they're using most of the time to measure that. And uh, when they show the data, the markets tends to move, it tends to vary in there. And also something that we're going to see later with the interest rate. So as a probable result of inflation, labor asks for higher wage to buy more, price rise to meet those wage, and inflation become a cycle. The Fed start to print more money and then wants to find a way to balance the inflationary aspect of printing money with the deflationary things like cut spending or the redistribution of wealth. And there are some other topics, at least to mention the last of these two that are so far I have learned in English. So yeah, and then I look at the describing here is uh, what is the principal, okay, like this. So the principal is the amount borrowed that remain unpaid, or the amount that you borrow, uh, the amount that you borrow, okay, or the amount that you borrow that remains unpaid. It also be seen as the monthly payment you do to reduce a loan or a mortgage. In the context of finance and investment, is the original amount that you give to a certain security, or you invest on a security. And in banking terms, is the principal is the original deposit or loan in which interest will be earned or paid. Uh, and then I look at the periods of consecutive negative stock return. So by looking at this four states, all right, or these four periods, starting from 1929 during the stock market crash, in 1939 at the beginning of the Second World War, in 1973, which it was during the oil embargo performed by the Petromonarchy to the U.S. because they were supporting Israel forces in the Yom Kippur War, okay, from 1973. And this is a very sensitive topic. I don't want to dive in too much, but it's very interesting to understand why the market at that moment fell so hard. And then in the 2000 with the dot-com bubble. So in all those four instances, which is something that Morris mentioned, in all of those four instances, the negative return has been followed by above average positive return, which is like this. Again, this pattern is not guaranteed to repeat itself, but it can show you the market potential and the importance to have a plan and stay focused on your investment strategy, right? So, yeah, the things to know here is investor must have discipline and patience, and a disciplined investment strategy is the best approach or for dealing with market downturn, and that includes dollar cost averaging. That involves continued purchase regardless of price fluctuation, and maintain a well-diversified portfolio, which is purchase stocks in different companies, perhaps in different fields, and the whole idea is to minimize risk as much as possible. So it is also is important to stay focused on your long-term investment. When we mean long-term investment is investment that you held for 1 year or more, that you hold for 1 year or more. And again, a word of this diversification and dollar cost averaging. Diversification does not eliminate risk, and dollar cost averaging doesn't protect you against financial losses or ensure you profit in declining markets. So it's important to consider that, because the next topic is crisis and long-term performance. So again, looking at historical data, and here where they examining is the oil crash, the stock market crash, something that in the draw again in the previous graph we don't have that, but of course it happened. Then in the dot-com crash at the beginning of the 2000, and in the 2008 with the banking and credit crisis. This last crisis, or in the 2008 crisis, happened in the developed countries. Because, for example, in Venezuela, we didn't feel even the breeze of that, because back then, well, and this is still up today, the GDP of Venezuela, of the huge portion of GDP, is basically on oil exportation. So okay, then we have the banking and credit crisis, right? So the thing here is that when you analyze each one of those crises and their length vary, some investors may think that they can time the market, and that is buy when the market hits the very bottom and then cash out when the recovery is complete, thus enjoy the entire upswing or the entire upside. But the problem with this type of reasoning, it is impossible unless you receive some privileged information to know when the market hits the bottom. So with all of this data, okay, and the things to know is that historical data suggests that holding on can pay off in the long run. It won't. This is a probability. It can pay off in the long run. So then I look at stock performance and after recession, and this historical data show that small stock has been one of the strongest performing after recession. So yeah, so many investors fears the volatility, and the volatility here is the degree in which a particular asset or in the degree in which a particular price of an investment fluctuate, right? Price fluctuation of an asset. So the more it fluctuates, the greater the volatility on a security. And if you are familiar with the crypto economy or the crypto universe, when you see the Bitcoin or the Ethereum or any other cryptocurrency, yes, there is a huge amount of volatility on that. The reason of that, uh, some blue whales that manipulate the markets, not only companies but also governments. For example, so Tesla, when they buy a huge amount of bitcoins and then discards that to get some cash flow. But the whole idea of this, of looking at this stock performance after recession, okay, is that the on average, the cumulative returns, which is this. So on average, the cumulative return of small stock outperform those of large stock after recession. And again, it's after 1 month, 6 months, a year, and 3 years after the end of a recession. Uh, so that lead me is to the new topic of the history of interest rate. This is something that I barely know that. And over these last 3 months, I have learned about what is the interest rate, which is a percentage that indicate what borrowed money will cost or saving will earn. And the interest rates, or the simple example of the interest rate is that it will cost you $5 to borrow 100 if the interest rate is set at 5%, or someone will earn $5 for keeping 100 in their saving account. So these interest rates react to these economic cycles, and in the 2020 they were at historical low to stimulate consumer spending. And after that they began to recently, or they began to rise again. So another interesting topic here is the loanable fund markets. So these loanable fund markets, uh, which when you look at, for example, Khan Academy, thanks to the open internet and the free access of informations, of course, you should check your source, please. It's for you, not for me, and for me as well. Is in the loanable fund market. The loanable fund market, like this. So the loanable fund markets, I just, for demo purpose or educational purpose, I'm just showing is this video for that. The loanable fund markets. You can look at that. But the idea is that these loanable fund markets, and again, you remember about markets, which is a place where buyers and sellers make transactions. So in this case, is these the savers and the borrowers, where they exchange. So if you imagine that in a small scale, for example, within your family, if you're privileged to be raised in a family, that once you ask your parent, well, you can ask for loans to them, right? And they usually won't charge you, right? But what happens if this is an example I really like to use. Let's say you have a benevolent parents and they give you a 5% anytime you ask them for a loan. Okay? Benevolent. And they love you. Right? So just for the sake of the example, imagine you also have brothers and sisters and you are the older one. So if you receive for if you ask your parents $100, but you have to pay them, if the interest rate is set to $5. So $5 uh, above the original amount, $105. So if you are smart enough, you say, hey, I'm going to look for my younger brother and I'm going to make him ask me for a loan. Why? Because he wants just to buy some ice cream, or he wants some any candies, right? So you have to. So you pick your brother for ask you a loan, and now you say, hey, you know what? The interest rate will be 7%. You think you're smart enough. So what happened here is that you may do that and replicate that to any of your younger brothers. So your parents, to prevent this type of behavior or defects, okay, they want us to know what happened in the markets, and the way to do that is by interact in the market itself, see what happened in the market, so they can regulate this type of behavior. Uh, so back to the example here in the loanable fund markets, okay, there are a number of interest rate reflecting loans of different risk and time length. So, for example, if we go to the U.S. bond, right, the U.S. bond saving bond, I don't think it's this. Yeah, you might look at this, okay, but their interest rate reflecting is risk and time length for that, right? So uh, example of short-term interest rates, and by short-term they usually mean is a year or less, are the federal fund rates, treasury bill, and the maturity bonds, 1 year or 1 year maturity bonds. So the federal fund rate is the interest rate at which banks lend fund each other overnight. So the U.S. Federal Reserve, which it was founded in 1913, we pause here. Why the Fed exists? It is pretty interesting, so you can Google that. But for the sake of the example here, let's move on, right? So the U.S. Federal Reserve, it was founded in 1913 by the U.S. Federal Reserve Act of 1913. It tells you here, according to Morningstar, and it establishes the discount rate, which is the interest rate set from the Fed to commercial banks when they ask for loans, and the prime rate, which is an interest rate set by the commercial banks to their most credit-worthy clients. They usually are companies or corporations. And it also oversees the national banking system. It creates monetary policies by also printing money. loans money and buy and sell government security in the federal open market to regulate this money supply, right? So the Federal Reserve System, Fed, is made of 12 regional banks and it overseen by the Federal Reserve Board. Okay, so the things to know of this is that the U.S. Federal Reserve set the target. Okay, is that the U.S. Federal Reserve set the target federal fund rates and try to achieve that target by buying and selling security in the federal open market. So, like the stock market, the bond market is also affected by the state of the economy. So, the interest rates on bonds are affected by the demand of loanable funds. So, during an economic expansion, the demand for loans increase as the interest rate, and during an economic contraction, the demand for loanable funds decline as the interest rate. So, with that introduction of the economic contraction and expansions, right? So that lead me is to the next section here, which is a summary of the staying investment in the market section, and that lead me to the next section. No, it's not. It's not this. Okay, is the market in terms and recoveries. Okay, and this is where I am right now, learning and understand this, right? So, so in this section, in this course, we will look at historical market contractions and expansion. So these graphical data show a very long time horizon, helps investors to see market performance. And this is valuable for anyone to have or to need or who needs to invest for a long-term goal, such as retirement. Uh, Honestly, I don't think that I will retire. Of course, my physical capabilities perhaps won't last me onto my silver years. Jesus, why North American people love to use the language to diminish the impact of things. It's like it's a fucking obsession. But in any case, uh, but the idea here is that, right? This is valuable for anyone who needs to invest for a long-term goal, such as retirement. And another value is that it can show how risk can decline over time. Two things here. By looking at this market contraction and expansion, as an investor uh, who wants to have this long-term goal or who have these long-term goals, it is important to see how the market performs and understand that how risk decrease over time. So when I started to look here at the stock market, okay, so yeah, the stock markets move in cycle with periods of contraction followed by period of expansion. There is a YouTube video, okay, I think is from Ray Dalio, and how the economic machines work, okay, where this is very illustrative, and Ray Dalio is a hedge fund manager, yes, he's an American billionaire investor and hedge fund manager who have served as co-chief investment officer of the world's largest hedge fund. This is one of the world's largest hedge fund, holy Bridgewater Associates, since 1985. So, so he made this series of videos about explaining how the economy machine works, and also the changing changing world changing world order, okay, like this, which is also
The
another
changing world order.
interesting video, okay. So I mentioned them is because he explains this market contractions and expansion, right, or this cycle where the stock market uh, move. So Morningstar mentioned is that over the past 49 years, from 1973 to 2001, there have been 10 market downturns, shaded shaded in yellow here. 3, 5, 6, 7, 8, 9, 10. Uh, this contraction phase of a stock market cycle, and by a cycle is a complete round of price in. I'm learning this. I'm learning here right now with you or with me. A complete round of stock price fluctuation. So this cycle vary in length and durations according to conditions in the economy. So, okay, a cycle is a complete round in price of stock price fluctuation. Okay, that's a stock market. A complete round of a stock price fluctuation. Good, good. And the green regions show an expansion phase. So a contraction. So in this text, which is something that I have read over the past 5 to 6 days. Uh, First is defining is a contraction, and then an expansion. But what it measures? So a contraction is defined by a period when the stock market value decline, or when the stock market value decline from its peak 10% or more, and this decline seems to happen at random times and lasts for varying time periods. The other is the expansion. So the expansion measures the recovery of an index from the bottom of the contraction to its previous peak and the subsequent performance of the index until it reaches the next peak level before another 10% decline. So, what is a recovery in an index? Okay, so recovery here is this. So expansion measure the recovery. So a recovery, a lump of swinging security price following a long decline. This description is somewhat similar to the trajectory of a baseball. All right, when someone hit a home run or during the soccer. Uh, so it's a lump of swinging security price following a long decline. And a recovery lies between a rally, this rally, and the bull market. The term recovery is also applied by the term recovery also applies to an upswing in the nation's economy activity. Upswing in the nation's economy activity. Uh, because my main language is not English, this might take quite amount of time to understand this. Uh, okay, so that is the recovery, right? So expansion measure is the recovery of a Jesus. So expansion measure the recovery of an index, and recovery is the Jesus. Uh, a long upswing. It's because that word upswing, I am not quite familiar with that. It's like, what the fuck mean upswing? I need to find some synonyms, meaning, upswing. Upswing. Yeah, because it's British. Oh bloody hell! It's British. Yeah. Yes, it's British. So yeah, upswing, upswing, upswing. So upswing synonym. Okay, upswing synonyms. Upturn, boom, growth, increase. Okay. Upswing, upswing, upturn, upturn. That's a phrasal verb. Upturn. Uh, so upswing, upturn, boom, growth, and increase. Okay. Boom, increase, growth, boom. All right. Upswing. Okay. So the expansion measures the recovery of an index, and the recovery is the boom or the upswing in price security following a long decline. And yeah, following a long decline. And the recovery stands between a rally and a bull market. And the term recovery is also used to describe the upswing or the boom, the growth, the upswing of a nation's economy activity. Mm-hmm. Okay, okay. That's interesting. That's interesting. And the index. So the index. This is something I know because I work as a software and Node.js developer. So I'm quite familiar with a lot of these concepts. So it's a statistical reference of investment expressed as a percentage in an established period. So a couple of days ago, I asked myself, what the fuck is statistics? Okay, what that word really mean, right? So according to Wikipedia, statistic from German, statistic is the description of a state or a country. And when I mean the description of a state, okay, this is one of the state. What is the definition of a state? Polity. This is one of the definition of a state, my friend. Oh my God! Here we are into the rabbit hole wonderland. Uh, Here we are on the wonderland rabbit hole. That's the word. Yeah. Uh, so the description of a state, a country. But this is not only applied for a country or for a particular state, but also to other states. So, for example, what was the last music you enjoyed the most over the past 6 months? All right. So here the state is, or the state that we're interested is music. Uh, or what was the last thing that you have learned that provide you the most outcome for that? And here we're interested is in that thing that you learn that produces you perhaps economic growth or that allows you to meet someone that is very, very interesting. So yeah, okay. So this is a statistic, right? So when you talk about index, so this statistic or this uh, description of a state reference of investment expressed as a percentage of an established period, okay? The figure used base periods such as specific year in the past, and the measure the rise and fall over time. For example, if a given index began at 100 in 1980s and stood at 150 in 1990, then the investment is measured. Then the investment it measured was 50% higher in 1990 than in 1980s. The purpose of an index is to measure progress. And I will stick with this concept, with this knowledge, or this definition. Yeah, the purpose of an index is to measure progress. Interesting. So the base period may change from time to time. So Standard and Poor 500 or the S&P 500 Composite Index and the Wilshire 5000 Index are examples of this. So once I look at this, the Wilshire 5000, in yeah, from Investopedia here. So what is the FT Wilshire 5000 Index? It's a broad-based market capitalization index that seeks to capture 100% of the United States investable market. They use a lot of jargon for describe is that it's a measure for okay, it's a market capitalization weight index for all stock company in the United States. Okay. Understanding the FT Wilshire 5000 Index, named for the nearly 5,000 stock. It contains a launch. Okay, but what is that? What is that? What is that? Yeah, because we're going to dive deep into the. Okay. Alright. Alright. Okay, what is this? Number of equity security includes low, down 30, NASDAQ 100, Standard & Poor 5000, and Wilshire 5000 Total Market Index. Representation of total market. Okay. Poor to excellent. One of them is okay. Representation of total markets. The bottom is the better, but the number of equity security includes are high. The more data you have from the markets, the better it represents. Okay. Interesting. Very, very interesting. Very, very, very interesting. Okay. So, with this, if we keep reading about this, the last contraction associated with COVID-19 pandemic began in December 2019 and ended in March 2020. Well, according to Morningstar or the market. Yeah, technicalities. The stock market recovery from this crisis in June 2020. Well, right now we are in another market contraction. It's not nuclear science, or I am not an Einstein to say that. But, well, we face that. We can feel it. Yep. While some periods of decline has been severe, the market overall has grown with time. For instance, the stock market fell by 14.7 from its peak at Monday in May 1990 through in October 1990, but grew by 355.1 from November 1990 to its next peak in June 1998. They're talking about here is this. So describing is this market contraction is here. For instance, the stock market fell by 14.7% from its peak at Monday in May 1990 to its through in October 1990s. For a couple months. So we talk about May, June, July, September, August. What? June, July, August, and September to October. So 5 months of recession. And when we mean recession, it's like, well, everybody is trying to survive. It's like that. We are like in Super Smash Bros, right? We are in a free for all. Exactly. Okay, something that it feels like that, in this moment. You feel the free for all. Okay. No one can predict market declines with certainty unless you receive some privileged information. Investors should have a long-term investment horizon to allow their investment to grow over time. Returns, something that we already mentioned, which is the earning of security or any other investment, certified deposit, dividends, realization of profits, income, other or some other source. Returns and principal, the original amount that you invest in the context of finance, the principal is the original amount invest on a security. Okay, so returns and principal investing in stocks are not guaranteed. Mm, About the data, large stocks are represented by Iboston Large Company Stock Index. An investment cannot be made directly in an index. The data assumes reinvestment of all income and does not account for taxes or transaction costs. Okay. So right now I'm looking is at the market terms and recovery. So first I look at the market contractions and expansions and the market terms and recovery. So we're going to use this analogy, right? So stock market contractions and expansion, and market downturns and recovery. So historical account of past downturns and recovery can present a better picture of potential market performance. Yeah, there have been many U.S. equity market downturns. In C, we can see is the downturn, how long that decline lasts. All right, 34 months in 1929. Holy, and the recovery. Uh, it lasts 151 months. Holy shit! This is about 13 years. 13 years. Do you think you have time for holding that? Ask your grandpa or grandma or any that live in that era, right? Holy fucking. Anyway, so looking at this more recently, for example, here in the 2000, uh, in the 2000 at the dot-com bubble, all right, the downturn uh, begin or the downturn lasts 25 months, and the loss it was 44.7 from September 2000 to September 2002. 2 bloody years. And then recovery, and then the recovery lasts for 49 months to 2008 until 2006. Holy. So even though uh, this is huge amount of month uh, on those downturns and recovery, and when we look at the here in the the banking and credit crisis, the 2008. So it lasts 16 months downturns. We're talking about a year and a half roughly, and the recovery lasts 37 months. Do you really think you have time for live that long? It's like what the? So there have been many U.S. equity market downturns over time, with varying levels of severity and different length of recoveries. The most severe downturn marked the start of the Great Depression, a period of about 10 years beginning in October 19, during which many people lost their job and many companies went out of business throughout the world. Desperate unemployed workers took their family on the road to look for work. One thing is that you read about historical fact, and the other is that you face and live historical fact. Okay. So when stocks lost over 80% of their value. In this case, the recovery period was over 12 years. The recovery period was over 12 years. More recently, stock lost 44.7 on their value during the early 2000 bear market. Mhm. This recovery period, lasting for 4 years, was the second longest in history. Stock lost 50.9% during the recent 2007-2009 bear market. This downturn lasted for 16 months, and the stock market recovered after 37 months in March 2012. You gotta be. It is so things to know. Stocks are prone to sudden loss in value for many different reasons. So it is evident that stocks are prone to sudden decline in value. This decline seems to happen at random, and there are many different reasons for stock market crash and bear markets. We might know why. Uh, People that are on the stock market, traders and bankers, they private, privatize earning and socialize losses most of the time. And if we are not informed, or if we're not dedicating time to learn more about this, uh, those things will still to happen. And what's worse is it will create huge amount of confusion and chaos. Sometimes stocks recover their value quickly, while other times this decline lasts for a while. Investors should have patience. Okay, so with this, I'm going to end this transmission about the stock market contraction and expansion in market terms and recovery.